Did you know Starbucks holds staggering debt, approaching $26 billion, despite increased revenues? Our expert analysis dives beneath the surface, unpacking Starbucks' substantial leverage, declining profits, and recent strategic investments that could redefine its market position. We've meticulously examined financial statements, competitive valuations, and hidden insights from earnings calls, packaging everything into this concise, insightful breakdown. Stay with us until the end to uncover whether Starbucks' bold growth initiatives truly justify these debt levels and your investment consideration. 1971, leads globally as a specialty coffee roaster and retailer, with nearly 34,000 stores worldwide. Operating distinct segments including North America, international, and channel development, Starbucks diversifies revenues via direct retail, licensing its established trademarks, and strategic grocery collaborations, providing investors valuable insights into its robust yet versatile market positioning. As of December 29, 2024, Starbucks holds $3.7 billion in cash, a meaningful rise demonstrating proactive liquidity management essential for growth and shareholder value creation. However, a considerable total debt of nearly $26 billion, resulting in a high debt-to-equity ratio, close to 26, signals significant leverage, much greater than some industry peers. While management has successfully maintained compliance with credit covenants, investors should remain cautious about such elevated debt levels, as this financial structure could limit flexibility or heighten vulnerability during economically challenging periods. Here is a screenshot of the full balance sheet. Notably, Starbucks' total assets remain stable, yet the increase in other long-term assets suggests strategic investments that could enhance future operational capacity and profitability. Starbucks shows exceptional financial strength in retained earnings and debt management, consistently outperforming industry peers, and the broader index signaling robust balance sheet discipline and prudent capital structure attractive for value investors. Starbucks' recent income statement reflects short-term margin pressures from strategic investments. The operating margin declined notably to 11.9% due to higher employee wages and removing extra charges for non-dairy alternatives under its Back to Starbucks initiative. These decisions have temporarily lowered profitability but aim to secure long-term customer loyalty and brand strength. For value investors, understanding these strategic trade-offs is crucial to evaluating potential risks and sustainable growth prospects compared to industry peers. Here is a screenshot of the full income statement. Notice the decline in operating income from $1.4 billion to $1.1 billion, indicating potential operational challenges impacting Starbucks' short-term profitability. Proprietary BOW score highlights Starbucks' competitive operating margin strength within its industry peers, yet reveals weaker earnings growth compared to the broader market, suggesting potential caution on future profitability expansion. Starbucks' revenue growth recently showed signs of slowing, with fourth-quarter revenues slightly improved over prior quarters, yet virtually unchanged compared to last year, largely due to fewer customer transactions. Profits suffered accordingly, dropping below previous quarters. To address this, management is actively pursuing greater operational efficiency and motivating their workforce to strengthen profitability over the longer term. Investors should carefully watch whether these initiatives successfully offset current revenue headwinds, safeguarding the company's competitive standing and stabilizing net income growth. Starbucks generated nearly $1.4 billion in free cash flow by December 29, 2024, rising notably from $737 million in the previous quarter, signaling effective control over capital expenditures during operational headwinds. The 88.7% CapEx margin highlights Starbucks' continued aggressive reinvestment into growth, balanced with disciplined spending. For value-focused investors, this indicates a prudent management approach. emphasizing sustainability and profitability and providing cautious reassurance amidst uncertain market dynamics. Here is a screenshot of the full cash flow statement. Starbucks saw strong operating cash inflow of $2 billion, which suggests solid operational efficiency. However, negative investing activities highlight significant reinvestments, a common approach for future growth. Starbucks' recent earnings call revealed critical insights for value investors amid mixed financial signals. While the management's strategic shift to reinforce brand quality and streamline menu items is promising for operational efficiency and customer satisfaction, current financial results raise concerns. Declining comparable store sales in the U.S. and reduced earnings highlight pressures from restructuring costs and rising coffee prices. However, planned expansion in key U.S. markets, such as Texas, and renewed marketing efforts focused on younger consumers could support long-term recovery. Investors should monitor closely whether strategic improvements translate into tangible financial strength. Analyst estimates suggest Starbucks net income could more than double by 2029, reflecting confidence tied to strategic plans like the Back to Starbucks initiative. Stable earnings per share forecasts indicate cautious optimism. Yet investors should note risks including unpredictable commodity costs and evolving consumer preferences. Monitoring how well Starbucks manages these challenges will be crucial in deciding whether current valuations offer true long-term value. Our proprietary BOW score highlights Starbucks' strong profitability compared to the broader market, but indicates room for improvement within its industry, suggesting earnings strength overall yet potential competitive pressures among industry peers. Starbucks appears attractively valued relative to Chipotle when comparing their price-to-earnings ratios, suggesting potential undervaluation in the current market environment. However, the negative price-to-book ratio raises notable concerns about underlying shareholder equity, showing significant balance sheet challenges, especially compared with peers like Wendy's, which remains positive. Investors should closely monitor how effectively Starbucks management executes on operational improvements and strategic initiatives, since these will critically influence whether the equity health stabilizes enough to justify long-term value investment consideration. Our discounted cash flow analysis forecasts Starbucks equity value per share at $74.59 by 2029, assuming near 12% annual revenue growth. While management aims to sustain balanced capital investments during operational pressures, how effectively Starbucks navigates competitive dynamics and market volatility will critically influence whether its future profitability can justify this valuation level to a value investor. A proprietary BOW score reveals Starbucks has a solid valuation edge within its industry peer group, yet shows vulnerability against the broader market index, signaling potential valuation concerns compared to major market alternatives. Analyst forecasts suggest Starbucks stock might face challenges meeting higher targets unless management successfully addresses consumer spending shifts and competitive pressures requiring notable strategic improvements to achieve meaningful growth beyond recent performance. In conclusion, Starbucks presents investors with meaningful strategic initiative strengths, particularly demonstrated by proactive liquidity management and prudent capital discipline, yielding robust free cash flow of nearly $1.4 billion. However, its substantial leverage approaching 26 times equity and declining operating margins to 11.9%, coupled with slowing revenue growth, indicate heightened risk and profitability vulnerabilities. Despite favorable valuation relative to competitors such as Chipotle, Starbucks' negative shareholder equity warrants cautious evaluation. Value investors must closely track whether recent strategic actions effectively address elevated debt exposure and operational challenges before confidently assessing true long-term investment merit. Make sure to watch another video from our Value Explorer series by clicking the playlist below.